And Aaron, the mic is yours.
Good stuff. So I'm definitely glad to be here. Today, we're going to be talking about fundraising kind of 101 and everything that it entails from a startup perspective to kind of give a quick overview of what we're going to talk about, because I think it's always a little bit nicer to kind of know where we're going. So I'll give you kind of the 10 seconds on our firm, but then we're really going to dive into the meat and potatoes of this. I tend to talk a lot. I tend to talk fast because I don't like those sessions that are, 30 minutes of pitching and then 5 seconds of value. I want to, get to the meat of it. So let's just do that. So we're going to talk about the types of investors, because knowing who you're approaching can structure what you need. So it's important to know kind of the realm that you're in. We'll talk about a basic overview of how to build a pitch deck. Now, I have a presentation on this that's, this length, if not longer, and has a bunch of details. I think it's on the Amplify resources. So feel free to check that out or reach out and we can discuss, no problem. We'll talk about the team, because of course, at an early stage market, the reality is that people are investing as much in your product, if not, sometimes multiple times more in you. They want to see who you are. They want to see what you've done. They want to see what value you bring, and if you have the team necessary to actually execute. We'll talk about financial projections, both in terms of what you kind of need as a quick reference to, get off the ground, and also some of the key metrics and focuses that are within a financial model that are going to be critical focuses to actually move forward. We'll talk about the capital ask, because it's important to know what you want and what's a good use of proceeds, what's a bad use of proceeds, et cetera. We'll talk about some of the skills that are necessary to raise capital, because it's one of those, if you don't have a paintbrush, kind of hard to paint type deals, where you kind of need certain skills in order to make sure you do it properly. It can be done, but doing it properly and, making decisions that you don't regret 24, 36, or, God forbid, many, many years after that, little things that come back to haunt you. One of those things where being strategic in the beginning can really benefit you in the long run. We'll talk about your investor relation strategy, because, okay, yeah, congrats, you got an investor. Now, how are you going to keep them? How are you going to show that you care? How are you going to show that you're busy and working and being productive and all these sorts of good things? And then I'll talk about some message templates, because, of course, outreach is a big part of it, and I'll include my contact info. So the 2 seconds on us, we basically try and be the kind of the phrase that I've been using, which I think is fair, is we are your part-time co-founders. We just happen to sit in this realm of business planning, so deciding how you're going to market, who you're targeting, and strategizing the very fundamentals of how does this business exist, right? Financial strategy, which is everything from building models, figuring out debt pay down schedules, understanding what you're trying to do if you're trying to buy or sell your company, and try and, understand what's going on or what are the mechanics around it. And then last, but certainly not least, is capital raise, which is everything from figuring out how much you need, what you need, where you're going, who you're pitching, how you're pitching, and kind of everything in between. So my team is a small team, but definitely very deep. Alex on our team is a former biomedical engineer that has a master's degree in finance. Hawken, it comes from a private equity background and previously worked at Morgan Stanley. So very quantitative kind of finance and biz dev focused team. So let's get right into it. So you want to raise money. Fantastic. The question is, where are you in the journey, and what investors are the most appropriate for you given where you are in the journey? Now, the way that I think about early stage doesn't, it means something, but it also doesn't, right? It's very fungible. It's very squishy. So I like to try and make it a bit more clear. So when I think early stage, I think of kind of 3 different buckets. Are you in your friends and family round, which is we're early stage, we're at idea stage, we're just trying out a few things, we're testing some stuff. Like these are, what you would feel are, man, I am just getting started, right? Then you start getting into your angels and accelerators, which are, we have an idea, we have a crystal clear vision of what we want to bring. We think, because it's always we think until you're $1 billion. And even then it's kind of, we're still thinking, but you want to figure out what you think your idea is, and where you're leaning into. And then I call VC and kind of these angel groups, they're like the late stage of the early stage, meaning you can't be nobody going to them, because unfortunately, there's a lot of money in the world and it goes to, it's going to more and more people, which is great, but it's still very relationship based, right? You have to know who you have to build relationships. And the thing about relationships, it's not just good enough to message somebody, you have to have something to say. You have to have a story to tell them. So while there are angel groups and while there are seed groups that certainly focus pre-seed, they focus at seed, they call themselves early stage investors. You got to learn their criteria. You got to know what they're actually focused on to know if they're truly early stage and belong, on this type a page, or if they're much more of a late stage fund that operates early stage. So as an example, if your business makes 50K a month, that's not bad. That's not all the money, but that's definitely more than some money, right? That's a good chunk to get started. And there are angel groups that qualify themselves as early stage that have minimum 50K MRR, so monthly recurring revenue requirements. Now, I don't think that's exactly fair, but mind you, it's not my money, so I'm not worried about it. But what I do know is that if you're someone operating in the ecosystem, you do need to be conscious of where you are and what you're asking for and what you're looking for. So friends and family, you're going to get the most leeway with. You're going to get the most, they're investing in you and less the business. When you start getting into angels and accelerators, you start getting more into kind of that 50-50 model where it's, yeah, they're investing in you because they need to see that you're the right person to do it, but they're also looking at the business to see if it even makes sense. Because at the angel round and at the accelerator round, these are the people that start to go, so talk to me about your model. Talk to me about how you're going to make money in 3 years. Talk to me about some of your products. Talk to me about your customer. There's a higher level of diligence and therefore a higher level of progress that's needed in order to make sure you can be successful in that level. Now, mind you, there are people with relationships at every one of these levels and 100 ones higher than them. They can get money off an idea and, you know, a glass of whiskey over an evening conversation, right? Those people exist. If that's you, fantastic. Raise the money, do the thing, like let's move forward. But if that's not you, you have to think practical. And you have to be honest with yourself. You have to be honest with where your startup is, and you have to figure out what's going to be the best fit and what's my right strategy. Okay. So a lot there, but it's important because you kind of need to know where you are if you're going to determine where you want to go. So how do you build a pitch deck that speaks to this? So let's talk to the right side first, because I think it actually will set up the left side. So there are 3 core reasons why investors care about you. And I build my pitch decks for everybody here, or these presentations. They have a lot of text on them because I think it was Chris that asked that, because he asked for a copy of it. And of course, feel free to reach out, because I like this to be able to be, you should be able to go through a Sharpie and cross off everything on these pages. And if you do, you're going to find that you're in a really solid place of your business. Even if you don't know all the things, even if you haven't done all the things, you still have a plan and you still touched so many major points that it's kind of impossible to be too far behind if you kind of cover all these bases. So reasons why investors care, there's really 3. Personal experience. So the example is, I have an application that works with medical practices that reduces waiting times in doctors' offices, right? We've all gone to the doctors. We've all spent an hour and a half there scrolling through Instagram. We know it's terrible. That is a personal experience that we all share. Now, there are some people that work in information security that have unique personal experiences. There are people that work in healthcare. There are people that work in coaching, whatever it might be. Their experiences that they themselves connect to and that they identify with. So finding investors that can not only assess your problem from what it looks like and what it smells like, but by what it feels like, right? Because they've lived it, they've touched it. That's such a great way to kind of bridge that gap and get some immediate connectivity, you know, from second one. Number 2 is ROI is clear. Now, mind you, you're dealing with investors, and investors are investors for a reason, right? They're not there just to throw out money left, right, and center, although it might look like it. And mind you, sometimes they do, but we don't want to count on that. But these are ROI focused people. They need to see the end in mind. They need to understand, okay, just because you're big doesn't mean you're valuable. As we saw with that startup that was doing, you know, mobile TV, the 7-minute episodes or whatever it was, that everyone feels like it was basically a fever dream. Like, did that company even really happen with all the billions? It's like, yes, because clearly just big clearly isn't good, right? It has to be viable. It has to be logical. It has to make sense circumstantially, because not only are you dealing with a business, you're dealing with a business in context, which means there's governments, there's social movements, there's race or religion or whatever it might be related context that will surround your business as you look to grow. And you have to be conscious going into that and understand this investor is looking at the same playing field and they're looking to make money because that's their job, right? Their mission, kind of as a startup, right, to make it a mission vision. Their mission, right, is to give people money, but their vision, kind of their overarching thing, is we need to satisfy the people that have contributed capital to the fund, or, you know, just their own significant other or family or whatever it is. They can't just go lose all their money, right? There's some people that they remain accountable to. And then last is professional experience. If you have a quantum project, you should probably talk to somebody who has professional experience in the quantum world, because they're going to get it. And they're going to get it in a way that somebody who's just off the street, who might have, Reddit level knowledge, or YouTube, you've watched 10 hours of videos level knowledge, but you don't have the years and credentials of being in the field to be able to really assess. So those are 3 areas that I think are really critical to harp on, because if you can check off as many of those boxes as possible, even if you don't get an investor, you'll get a friend. And a friend will connect you to other people. And a friend will push you to relationships. And a friend will make suggestions. And those friends will lead you one step closer to capital. Capital is very much an inch by inch type game, where you're just kind of like pushing down a wall over and over. And eventually, kind of like Shawshank Redemption, you're just, one day you break through and you get that first lead investor, or you get the first email back, or you do what it is, and then you build momentum and you do what you can. On the bottom, this is kind of thematically. So as you build your startup pitch deck and as you tell your story, these are things to always focus on. Make it simple. And simple is a weird word, because simple isn't simple. What simple means here is clear. And that means clear what you're doing. Clear, I mean, to a T, what you're doing, who you're serving, what your product does, what outcomes they should expect or you're aiming for. Like, you need to know. And the example that I'll give is, we've all been on some coaching website somewhere, right? Where somebody who's in like their early 20s is talking about being a life coach, and they're talking about, reinvigorating change. And it's like, okay, well, nobody knows what that means. And a lot of startups don't realize that, unfortunately, their pitches sound much closer to that than it does. We are an education focused platform that serves Latinos in the United States with a fintech education system that focuses on lessons in a constrained period, or whatever it might be. We're a medtech community that focuses on smart diapers for the elderly and aging population in home care. Nobody has any doubts what I just said. You might have details, there might be things, there might be nuance, of course. Every startup has a million pieces, and then each one of those has 10 dependencies. I get it. But what you do needs to be crystal clear. It doesn't have to be 100% accurate. It doesn't have to be that this is the one thing you're going to do forever, but you have to make sure that it can understand what you're doing. Compelling. Now, compelling is a weird word, because basically what I'm saying is be salesy. And that means salespeople don't just say the good, they explain away the bad, right? It's always better to head it off early. So you want to make sure that whenever you're describing your company, every time you explain it, it's one of those things. I'll give you an easy kind of personal example. Nobody likes the person that complains about their problems. People like the person that, your friend, that shares what they grew in their problem, that shares how they developed out of their problem, that shares how they were able to share their problem with a community and make adjustments. People like when people have action associated with issues, right? Because that's all you can do at the end of the day when you have issues. So in the same way, your deck, if it's good, tell them it's good. Shout it from the rooftop. And if there's things that are weaknesses or bad, that's fine. It's okay for something to be inefficient. It's okay for something to be, bad. It's not okay to not be honest about it, or at least know it, even if you don't plaster it on, page 1. And it's also not okay to have a plan, to not have a plan to solve it. And it doesn't mean, oh, we don't know how to solve our B2B enterprise sales channel, so that's it, we need to solve it. It's like, okay, well, have you talked to a consultant? Have you talked to somebody who can, fix sales? Have you talked to somebody who's in the industry who can give you contact of one of their friends, or whatever it might be? It doesn't really matter. But are you doing the things, or do you have a path forward that shows that even if it's not efficient, you're still moving, right? It's very much if you can't run, I think it's like Martin Luther King. If you can't walk, you can run, or if you can't run, you can walk. If you can't walk, you can crawl, but keep moving forward. It's the same idea. You need to show that come hell or high water, this business, investor with your money or customer without your interest, it's moving forward. And that doesn't mean being hard-headed. It just means being tactical, looking at things like it's a war, where you're going, I need to win. And winning for me is surviving to tomorrow and hopefully getting 1% better. How do I do that? So the last thing is easy to act on. And easy to act on just means you need to know what you want. Whether it's a mentor, whether it's a random conversation, whether it's an investor who has money in the bank, if somebody says those magical words, what can I do for you? Or what do you want? Or how much are you asking for? Or what's your valuation? Like, do not go into an investor meeting and not know how you want to raise the money. Don't know what your minimum and maximum amount you're looking for is. Don't know what the rough allocation of it is. Oh, 20% is going to marketing where we want to hire a saleswoman. 30% is going to our development team. We have, half of our team onshore, half offshore. We've got some operational expenses, and I want to come on full time so I can manage and scale. Industry average salary 60K. I'm asking for 50 for managing what we need to do, blah, 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 right? That is an ask. What isn't an ask is, I have a tech startup. I think I need 150,000 to get it off the ground. It's like, okay, well, how do you know that? Have you spoken to a developer? Do you know how complex your infrastructure is? Because we worked with companies that 100 grand was 2 times more than they needed, and they're living good because of it. We also work with other companies where asking anything less than $500,000 doesn't even make sense because of just the capital need that they have. So you need to kind of understand what you want, and it doesn't always have to be money. If you don't want money, what you do want are relationships, because relationships are just money later, eventually. So when you go somewhere, if you don't have we're not raising capital, guess what? You want to meet investors, or you want to meet people that are doing investments in the world, or you want to meet somebody who's involved in the industry. Or you always have something that you can get out of the conversation, because if somebody offers it, you want to make sure you can get that one step closer to it. So structuring the pitch deck, most of it's here. It's pretty simple in terms of there's a whole bunch of things you can cover. And what I would recommend is, legitimately, you should start with 11 slides. The 11 slides should have those lines written on them. One-liner summarizing business, the problem, the solution, the why now, the market, etc., and answer all the questions within them. And there's a separate, I don't want to go through the whole thing because it's a big process, but the long and short of it is, these are kind of your shortcuts to what you're trying to prove through these pages. So for example, the problem, you're trying to show that it's real, and you're trying to show that it's painful. Now, what that means is that real means that it's more than just, statistics show. Real is we've interviewed 50 customers or leads or potential customers. Real is we have businesses, we've talked to 20 of them, and we can see that they've lost, that our software helps them stay in compliance. We've spoken to 10 businesses that on average have spent 20K a year in fines because of accidents not staying compliant. That's real. That's painful. Good, your box is checked, right? There's a million ways to do it better, of course, but at least you're starting strong. Going to solution. Does the solution logically and effectively solve the problem? And by logical, I mean, if you're trying to, solve one problem, make sure that it's very clear what the solution does to solve the problem. It should be almost like sentence to sentence, left and right side of the paper, because one of the most common questions, and it's really just devastating to see, that gets asked to startups after they pitch is some version of, so your solution does this? And what that basically said is all the other words that you said kind of didn't go anywhere, because that means they didn't understand the basic of what you were talking about. And you'd be surprised how many startups, because you've spent 100 hours a week thinking about this, the investor hasn't, right? And imagine this, imagine your investor invests in e-commerce plays in California. So that means they're probably seeing 50 e-commerce deals a month, right? So they're very jaded, intentionally or unintentionally, to just big fancy things. They want to see things that are proven, things that are real, things that are exciting, innovative. Of course, innovation is the startup founder's value add, right? So these are things that you can do that really just increase your odds of capital raise, because that fit, not just product market fit in the sense that people want what you're offering, but that problem solution fit, that your solution isn't just in demand, but that it actually solves the problem you're going out there to seek, right? Or going out there to solve. The last one that I'll touch on in a meaningful way is why now, because I think it's important. The rest is, pretty clear. But why now is really important because COVID has shown that the world can shut down, and A, some businesses will die, B, some businesses will stay the same, and C, some businesses will grow and thrive. Now, from an investor perspective, are they counting on another COVID? No. Are they counting on potentially systematic or systemic weakness in your industry in 5 years? Maybe they're thinking that, okay, COVID just shows that there's a lot of people working from home. Okay. So what if it was just work from home was every day instead of it being COVID related? Does your solution work in a only working from home basis? Is your solution adaptable? Is your problem, scalable in the actual world we live in, not just this fancy perfect world where the economy doesn't go up and down and tweets don't change, Elon Musk tweets don't change Bitcoin prices. Like, this is the world and this multivariable, chaos theory inducing system that we're stuck in. So we must plan and mitigate and do what we can, around it. Why now is really why should you tackle this now? As in, like, why is now the time to solve this? If there was a time, the example is this. I met a guy who started YouTube 2 years before YouTube. And what ended up happening is there was no bandwidth, broadband access in this way wasn't achievable then. But as soon as it came out, then all of a sudden this little video distribution platform that couldn't get off the ground because the infrastructure, the tech wasn't there, now became an empire, right? That is like kind of like right place, right time, that whole deal. But it's also why now is in healthcare. Okay, we're in a post-COVID world and we need more home care services. Why now? Because people are scared to go to the doctors because the doctor office might kill them. You know what I mean? There are so many little nuances that can come into play and so many ways for you to show not only why is this valuable today, but how can this be valuable going forward, long into the future and long into, economic changes. The team. So team is super important because, like I said, the earlier you are in this chain of family, friends, angel, VCs, et cetera, the team is never not going to come into question because, of course, somebody's got to do the work. So who's doing it? But what it means is the team does need to take kind of more of a direct role in terms of how are you validating that the team is good enough to actually do it. So I view it in terms of three lenses. Are they qualified? Are they competent? Are they committed? So qualified is all the basics of, do they have the degrees, the certifications, the online certificates, the MIT the MIT degree at Harvard, whatever it is, that's the super mega of whatever they are. And you don't necessarily need to have that, but it's one of those, if you can show you have it, it's not a bad thing to show, especially if you're very technical or you're focusing on a very technical solution that kind of requires a technical person to even execute it at all. Competent. So competence is more of a track record thing. One, it's your presence in the room. Like, you have to not necessarily sound smart, although sounding smart is kind of part of it, but you need to show that you have competence in your domain. That if you're the salesperson and sales comes up, you'd better almost like run out of breath because you have so many things to say about sales because you know that world so well, right? Or you want to be able to say, yes, I'm the salesperson. I have 3 companies that I tripled their revenue in the first 6 months that I've worked with them. And now I joined this team on a part-time basis to help them build out their B2B enterprise offering. That's an introduction. That says something. And mind you, there's more questions to ask and schools and types and industries and time periods and situations. And yes, but do they have some sort of track record in school, in life, in personal, in practice, in play, whatever, that shows they're competent in their domain? Last is committed. Now, committed is one of those interesting ones because it's kind of the world that I play in. And the reason that I say is, if all your team is part-time, you have a team, but you also don't have a team, right? You want people to be full-time because that shows that you really believe. But investors understand, if you're starting an early stage business and you are a part-time account executive at HubSpot or something, and you don't have the money to take a 50K a year hit and not make any money, and you need to continue to work, then of course you're going to be part-time. But if you can get more people to be more part-time, or get more hours, or show that there's, advisors and board of directors and mentors and people that are committed to your success, that you have a team behind you, you don't need 100 people, but it just is. I'll give you the example. If you have an education platform that works with, let's say it's an education platform that gamifies how parents teach their children finance or personal investments, and nobody on the team's a parent, how does that look to the investor? Looks pretty silly, right? Well, you'd imagine how many people are, oh yeah, I've built a software platform, or I work in software development, I'm going to build something that caters to the needs of the physical therapy world because my physical therapist mentioned something one time. It's like, okay, well, yeah, that's great. Like, it's good that you're competent, you can build it, but get a physical therapist, get someone with a medical degree, get somebody that oversees physical therapy clinics to either join the team, be an advisor, be a mentor, but fill the bench so that way all the areas of your team, and I look CEO, CFO, COO, so your operational person, which is, basically your CEO on day one, your legal needs, your marketing and sales needs, like right positions that your company needs. And my version is very simple. If I don't do it, then somebody on my team needs to do it. And if somebody on my team isn't doing it, can we afford to hire somebody? And if we can't afford to hire somebody, can we get a mentor and advisor to help us out, to give us advice, to show us what we should be doing, to be some sort of pillar that the rest of our house can, lean on, given that we just don't have the resources or don't have the ability or don't have the time or whatever it might be to do X, Y, and Z. Financial projections, quick reference. So this is a slide that I have in the other deck as well, but basically it's kind of a quick check to make sure you're building your financials correctly, because if you're looking to raise money, people are going to want to see what you're spending it on. Typically, you'll get asked for anywhere from a 3 to 5 year projection model. I typically think in terms of 3 years, because 3 years is good enough to actually, you can make a 24-month contract. You can make an 18-month or 12-month agreement, but you can't tell me that you know what you're going to eat for breakfast in 3 weeks, much less 5 years from now what the margin is on your 5th product. Like it's an asinine ask, just because it's so far away, but it's fine because you can still model it, you can still think it through. But the exercise in that regard, and the exercise within the 3-year model, which we focus on, is very much have you taken all the necessary business considerations and financial considerations in mind when asking for this capital, understanding that there are certain goals, metrics, milestones, whatever it might be that you want to hit. And also, when you want to raise money again, because likely you will, because your first raise or two, you're still probably going into the red because you're still trying to grow and expand. Do you have a plan for profitability? And raising money takes time, anywhere from, let's call it 3 to 6 months on average, right? With some people, it takes 18 months. It really just depends. But let's say it takes 3 to 6 months. Let's say you raise money in January. That means in June, you have to start raising money for the end, because it's going to take for the end of the year, because you can't start raising money in December because you're going to run out of money. And then you're just in this no man's land and you have to fire people, or just the company up because plan your capital need appropriately. You didn't see where the cash flow was. You didn't understand that in the very beginning, you should have said, we have 12 months of runway. We're going to find a way to stretch it to 14. At month 4, we're going to start figuring out where we are. At month 6, we're going to pull together all our finances, business planning, models, team, whatever it is, because we know starting at month 6, 7, we need to start going out to market and talking to people. So that way at month 13, we're already pulling in the money. And all of a sudden we had our money dovetail, which is the best way to do it. So that way the last money ran out after the next money came in, right? So when you're building your model, these are kind of some good ways to think about it, making it as simple as possible, but as complex as necessary. This is really, make sure you take in the minimum viable but honest representation of what making money and managing your expenses looks like in your business. Having defendable assumptions, this is very much an industry question. So if the industry average for EBITDA margin or operating margin or whatever it might be is 10% or 20% and yours is 40, if the person you're talking to knows the industry, they're going to go, what's up? What's happening there? And if you shrug because you don't know that the industry average is 10 or 20, that's a problem. That reduces confidence. That raises questions in your foresight and your interest in the industry. The more extreme example of this is they bring up a competitor that you've never heard of, right? That's that experience. That's this in the finance world of, what do you mean your gross profit's 30% margin? What's going on there? How do you have 70% of cost of goods sold? What's this product? How does it work? Et cetera, et cetera. And again, that's the kind of the last point as well. In terms of kind of your core tabs, this is very much a basic, but make it simple, make it presentable, have your revenues and expenses in 2 tabs, have your assumptions so you can drive everything from one area. So, we're assuming we're growing 3% month on month year 1, 4% month on month year 2, and 5% month on month year 3. Can you change those? Can you make it 7% year 3 live in the meeting? If you can't, you should try to, because those questions and those opportunities will come up. You don't want to be hamstrung by a hard-coded, poorly linked, or poorly thought through no fault of your own. Of course, you're not trying to make something bad, but not everybody can paint. Not everybody does finance. It's fine. But figuring it out and making sure that you have a useful tool, not that you just, and it's something that we do in our business, especially. So I take it very seriously, but it's me handing you a financial model does nothing for you. It really does nothing. Me educating you on how to read, interpret, and use that model for decision making, especially updating it as well. That is a CFO. That is helpful. And that's what the investor wants to see, that you can not only, you don't just have the model done. It doesn't just look big, but you can go as the CEO or COO or whoever it is and go, yeah, you'll see in year 3, we actually think our margins are going to do this. We're talking about a contract in year 2, and that contract is supposed to actually span over and should open some interesting B2G opportunities. And like that is a decision-making capable strategic organization. And now mind you, everybody's on a scale of 1 to 100. The 100s are the hedge fund guys and private equity guys that know finance, in the back of their mind. And then there's the people that finance is a brand new word for them, and fine. It's okay to be early in there, and it's okay to have mistakes and stuff, but these are at least goals and things that I would recommend you work on, because every single one of these things that you do and you do well is one more feather in your cap and one step to actually getting capital. So within the financial model, I just put this as like a quick reference guide for people, so that way you kind of know what you need. So basics, KPIs, you should know your measures for success or failure, because if there's no way to know if you're doing well or performing poorly, how can the investor feel comfortable, and how can you feel comfortable? You want to have some goals every week, every month, every day, whatever your time period is that makes sense to you, but having specific, well thought through, and not 100, but the reason I put North Star is, what's the one metric you'd bet your company on? For Uber, the example is they would bet it on rides booked, because rides booked is the intersection of delivery, the driver, and demand. So they can take two variables of, amount of drivers on the system, or the amount of drivers getting rides, and the amount of people on the system, or the amount of people looking for rides. They can just go, well, let's just do where they intersect. Let's just do the actual amount booked, as an example. Revenue streams, pretty clear. Making money coming from, what are the assumptions? Are you using digital marketing? What's going on? Cost of sales. So of course it costs money to make money. So what does the product cost you? What's your operating profit and these different items? Variable and fixed costs. So everything has a variable and a fixed component, because office space might be fixed, but maybe as you scale, and you scale very quickly, it's going to become more variable because you need the team to be in person, right? As an example. Operating expenses, just keeping things up and running. Profit measures, knowing how profitable you are, and if what your profitability should be expected at, whether it's a 2-year profitability, a 5-year profitability, a quick profitability, a slow but steady profitability. Know your realm and be able to speak to it, because the investor is going to look to you and say, okay, what's the quality? Key performance indicator. So pretty self-explanatory in that way. And there's 100 videos on YouTube that describe it and, explain it well. I can always provide more context, but hopefully that's helpful. Your hiring schedule, because of course you're not building this by yourself. Unless you're building something that's fully automated, you're going to need to hire people over time anyway. So when do you need a salesperson? When do you need an onboarding person? When do you need a tech person? What type of tech person? Do you need a senior or a junior? All relevant questions. Your capital ask and use of proceeds. So we've talked a little bit about the left side, so I'll focus on the right. And the right side is very much not all use of proceeds are created equal. And what that translates to is, if this pie chart said 80% for launching my sales effort and 20% for management, and that's it, or the worst, like 40% for management salaries and expenses, and then like 60% for sales. It's just one of those things where I go, unless the story behind this is really good, which it probably isn't, because this is not how cap tables or that's not how use of proceeds usually look, there's a problem here. I put on here what a kind of exciting cap table looks like, because the story I would tell with this company is twofold, or is a couple layers. One, we're developing new features on a system that we already have live, and we're expanding into a few different areas that we've done surveys with 5 different customers in our concentrated geographic area, where we know they want these things and they're also willing to pay for it. So we're building out some new features. We're expanding our sales team. We have 2 salespeople that are working part-time. We'd like to hire one of them full-time and get the second, and I'd hire a third part-time person in order to expand our efforts more into the Kentucky region and the efforts that we're working on there. On the legal side, we, through our business, have ongoing contractual needs, and we're going to need to update more and more agreements and negotiate more and more partnerships. So we know we need capital there. And then we have a minimum level of office operations, making sure we have a front side basis and some relevant PR, et cetera, or, day-to-day marketing and office needs, staplers, papers, et cetera. That is a very different tale than give me $100,000, 80% of it's going towards me putting in digital marketing to launch my product, right? Investors like to invest in things that are expanding, not starting. And that is and I would really pay attention to that phrase because it's really important. So there's a difference between you starting your sales process and you already doing a sales process and then you asking for more tech or more money to make it more efficient. An example, let's say you're calling 5 people a week. Great, fine, no worries. Now, as a part of this investor thing, you're not launching an investor process or you're not launching a sales process. You're saying, I'm currently doing sales. I'm doing it very inefficiently because I have limited time and I work 9 to 5 and blah, blah, blah. I want to hire a part-time salesperson to pick up where I've left off. I, on average, am getting at least one person a week or one person a day book a follow-up meeting with me. These are the expectations that I have, and this is what I want. That is a very different story, as I'm sure you can appreciate, than I've never made a phone call. I want to hire some salesperson to just do my sales for me. It's like, who would you invest in? Who would you invest in? Would you invest in somebody that said, I've never made a sale, or I've not talked to the developer to price out things, or I don't know what my office space is, or I haven't spoken with a lawyer to figure out what they cost? Would you trust them with $100,000 or $30,000 or whatever it might be that's your investment? And if you wouldn't, make it so that you would invest in it. If you would invest in it, then you can be certain that at least a few more people will give you some benefit of the doubt. The last important is you need a time frame, meaning this 12-month runway, typically you're dealing in 6, 12, and 18-month level increments, because the first 6 months are about proving it. The second 6 months, you're raising again for, the end of the round. So really you're kind of looking at your capital in 12 to 18-month windows. But that's important because your capital takes time to get it. It takes time to go raise more capital over time. So unless you plan your cash flow need correctly, because we've seen plenty of businesses where, yeah, you've made 100,000 of sales, but those are all B2B 2-year contract lengths. So you haven't earned any of that money until month by month it goes by. So you could be sales rich and cash poor, or you could be sales rich and not feel comfortable spending your cash, because if they have the ability to cancel in 30 days and it's a $100,000 contract, whoever runs compliance in your business would call you crazy if you wanted to just start throwing that money out before the time period where they could instantly ask for it back passed, right? As an easy example. Skills necessary to raise capital effectively. So and the reason I put this here is, if you want to talk to us, by all means. If you want to talk to mentors, to Mike, to all the people in the community, do so, but do not raise capital without these in your back pocket, or else if you get a fair deal, it will be an accident. Because financial strategy ensures, or people that work in the finance world, people that understand these terms, people that understand safes and convertibles and Series A versus Series B and pre-seed versus seed and how it all gets negotiated, they're going to make sure that A, you get fair pricing, because not all deals are created equal, and B, that how much you're raising actually matches what your need is, right? Because you might think that you need 100,000, but your actual minimum level of need is 300,000. And now if you've only raised 100, you're in a really awkward phase where you shouldn't raise 100 to raise 200. You should raise 100 to then go raise 1 million or 1.5 million or 3 million or whatever it might be. Business planning, this is a kind of a continuation of the financial for us, because we will look at it all together. It just emerges. But how are you planning the business? What are the areas of growth? What are the areas of hiring? What are the areas of weakness? What are the areas of most effectiveness that you want to reinvest in? Because just because something's working doesn't mean it's cheap. In fact, it could work and you want to put even more money into it, which of course costs money up front. So knowing that and knowing how these kind of skills can be utilized to make sure you get the deal that your business needs, not just the deal that sounds good, very helpful. And then last but not least, legal protection. So unfortunately, not all deals are good deals. So you want to make sure that you're not getting any funny clauses, any weird kickbacks, any protections that aren't fair or aren't, equivalent. or aren't balanced, those are not things that you want to do. So making sure you have a good lawyer. And here's my rule of thumb. If your lawyer's your friend, it's probably not good for them to be your lawyer. And it's not that they're a bad lawyer, but it makes things complicated because you really need to kind of hold your lawyer's feet to the fire to make sure they're doing the things quickly and doing what you need. But the other thing is, startups, especially if you believe in your business, and it sounds silly, but especially if you believe in your business, like you're not just dabbling, you need to make sure that your startup lawyer isn't a first-time startup lawyer. They'd better have the word startup written on their page, on their LinkedIn page, on their company page, and it better be one of the first words you see, because there's so much nuance to everything from your taxes to the agreements to the terms to the structures to the generally accepted principles, which is an easy thing to mess up. You bring a lawyer that doesn't know what they're doing and a wrong contract to an investor meeting, and that investor goes, do you not know what you're doing? Or do you hire people that don't know what they're doing? I don't really like either of those options that they could be, right? And how silly would you feel, and frustrated would you be if it was, wow, because I went with my cousin or my friend who was a real estate attorney who said they could handle it, they've got you, versus the person that costs 3K, but man, they'll actually do the work. Like, you need that in your corner to whatever level you can get it. Investor relations. So this is, okay, you've got your investor. Now what are you going to do, right? Or how are you going to, find them and communicate? So the North Star metrics, so making sure you have your KPIs, on making sure you understand your investor level. So if they're friends and family, give them an update once a month, once a quarter, in a quick email, something simple. If they're a VC, you're going to want to put out regular updates, maybe even weekly updates, maybe monthly updates, whatever it is that shows them that you have comfort that you're building properly over time. That's a good place to be. And then communication, of course, don't leave your communication random. Structure it, have a plan, develop it, refine it, improve it over time, but start with a template and then go from there, because you're going to not like it being Friday, 7 p.m. on the last Friday of the month, and you're sitting there at your computer going, hell, what do I tell them this month? It's like, no. We have the KPIs, we have our updates, we write down bullets every week, we do what we can do, boom. It's a 10-minute exercise to compile it, and I out, and life's good, right? That's the goal. Last but not least, some of your messages. So you can meet investors anywhere. You can talk to them anywhere, because your investors, they can be any of those things, right? If they're friends and family, you're just going to send them a message and come prepared to talk deals with them, right? If they're angels and they're different people, again, you're going to do the same thing, but you're going to come prepared with your information, with your knowledge, with your write-ups, whatever it is, to talk business with them. And if they're a VC, I mean, you better come in a suit of armor, right? Because they're friendly VCs and they want to help you, but remember, they're there to make money first. And you have to understand that and know that that's the world we're playing in. So better to play smart than, play foolish. So these are some very easily mocked up, and you can take a screenshot or whatever of some example messages that I regularly send. So everything from a general LinkedIn message to, hey, it seems like you're doing some cool stuff. Can I connect with you? And a lot of people respond to that, because I'm not trying to sell them anything. I'm just saying that your stuff looks interesting. Let's connect. That works more times than I can even count, because I'm just trying to build a genuine relationship. The bottom left one on LinkedIn could be much more direct. And I have clients that use this all the time. Hey, I see that you're active in the fintech space. I would love to, we're currently raising a $3 million round. I'd love to send you our materials. And mind you, if you're looking at somebody and they have an official website and they have ways to submit, you should go through the standard and then poke them on the non-standard, meaning submit online and then follow up on LinkedIn. But if there's not a way to get to them easily, go to them directly, because not a lot of people will. And the people that will go often go so poorly that you can really stand out by just doing a few things. On the right, what I did is I put together a very kind of MVP of what an investor update email can look like. Hey everyone, it's been a great quarter. It's here at Argent Strategies. Since our last update, our focus has been on building more community relationships, especially in Kentucky. Key results are we connected with Mike DeCenso, Larry Horn, and Jordan Clemens, and have really gotten a chance to get involved and communicate with people. This month, we're hosting a session with Amplify. Our new goal is to actually host 4 more sessions by year end. The biggest challenge we're dealing with is not being there locally. So so if you happen to know somebody that has a COVID vaccine, we welcome it because we want to get there as soon as we can, right? So I made all that up just off the spot, just, having fun with it. But you can see how you could do that with any business and just fill in the blanks or fill in the thoughts and write something that's meaningful, that an investor would care to see and that has value besides just, looking nice. The last thing that I put there is very much kind of what I call the social pitch, which is if you the one sentence to all these things, you can pitch anybody, anytime for basically anything because you kind of have all the ammo you need. Then it's just a question of what you focus on. So boom, 50 minutes of just sprinting as per usual. So I'll pause there and I'm more than happy to take any questions.
I never want to rush you, Aaron. I told you could go over if you wanted to. You're always such a rock star.
All good. Happy to help. And, as always, walls of meetings. So wanted to make sure I was, within the time, left some time for questions. I'm of course happy to answer questions now. If people want to follow up with me, that barcode goes to my LinkedIn. So feel free to email, LinkedIn, text. I'm not particular, and I'm always happy to answer some Q&A.
If you'd like to unmute yourself, feel free to do so or type in the chat and I can read it out to Aaron. Aaron, what kind of frequency should you have with your investors post-investment? What kind of frequency of messaging and your board updates?
Yeah. So the way that I think about it is it's kind of one of those, once you start, you can't really go back. So you want to set a regular frequency that is comfortable for you, but it's not overwhelming. So I don't recommend starting with weekly because it's too much. And until you have I'm all for doing weekly updates because your business lives in days and hours. It doesn't even live in weeks and months. So weekly updates are very helpful, but unless you have a team or it's not your day-to-day responsibility to do that, because what you don't want is your startup to get bogged down by admin, just BS. You want to focus on value add activities. So I recommend starting with monthly because it's something you can build over the month, something that at max can take a half hour, an hour to put together once a month. When you get to bigger scales, you'll switch to a quarterly update because other companies do. But in the early days of a startup, a quarter is equivalent to a month for you. And investors want to see that you're moving and you're grooving and you're growing because 3 years is not 3 years. 3 years is 36 updates. And 36 updates is not that many. That's an update a day for it's an update a day for a month and a week, right? When you break things down by the arithmetic and you see like, oh, damn, we really can only send 30 emails and then we're basically going to be a mid-level startup business, 3 years into progress. That's meaningful. So that's at least how I view it conceptually.
Thanks for that. Hey, Aaron.
Hello.
This is Chris. Hey, I had a meeting with, I got called an acquaintance a couple of weeks ago, and this guy has never really been in the startup world, and he was new, and he took some early on investment from a family member, and I felt the valuation that he put on it was pretty low. And I know valuation could be a whole nother, couple hour conversation, but I don't know who's on this call, but it might be good. I don't know if you could share just some 101 tips for trying to figure out that early on valuation when you're talking to friends and family, or and I know you touched on like notes and stuff like that, and I get that, but just for some of those early stages like you were talking about, I think it might be good to kind of touch on if there's any just 101 tips you have. I think that could be helpful too.
Absolutely. So I look at valuation a couple of different ways. So I'll try and compress them all into one answer. So one is industry averages. So when you look at like a classic Silicon Valley level, and so two things. One, you want to look at stage. So we're assuming early stage, seed, pre-seed. When you're looking at these companies, there's kind of two ways to focus on it. One, what's the valuation they're aiming for? So the average Silicon valuation is anywhere from 2 to 5 million at like a pre-seed or seed level raise, depending on what size they're at, of course. Mm-hmm. So working under that, if that's, prime time valuation, I personally, and this is just I don't even want to call it a belief. It's more of a principle. I don't believe that startups are worth less than $1 million ever. So that means that a million's my minimum. And the reason is because if you have any level of success, right, let's say you make $100,000 in sales. They say that the easiest way to create $1 billion company is to create a $100 million company. And what that means is create 100 million in sales, you get a 10x valuation, which is, you value the company based off of 10 times the value of its annual revenue. So you have $1 billion company through $100 million revenue, right? And yes, even pre-revenue, because just because you're pre-revenue doesn't mean you're not pre-value. You could be pre-value. There's plenty of post-revenue companies that are pre-value because they still have no idea what the hell they're doing. And I know because they're realizing that they're making money, but they still don't know what they're doing. So then they call me and go, things are falling apart. And I'm like, okay, well, let's throw in some, rebar in the floor and some steel in the walls. And all of a sudden, things will get better. But pre-revenue is much, have you done the work to show that it's post-revenue? I'll give you an example. If I told you there was a startup that had $50 million in letters of intent from doctor office facilities, 300 people pre-registered to their platform, and an executive team comprising, 2 full-time people, 2 part-time people, and 1 industry veteran, they have no money. They've made no money at all. But I bet you that business is probably worth about 10 million bucks. Right. So to that end, it's very much what you're worth is what you can convince. It's the old saying of you don't get what you deserve, you get what you agree to. So in startup world, you don't get what you're worth, you get what you can convince somebody you're worth. So for me, I don't like to go less than $1 million because I look at it not only from the front lens of how much am I worth? I'm worth $1 million, I'm worth 10 million, whatever. Fine. I look at it from the other side, which is if I want to raise $100,000, how much of my company do I want to give away? So I know the average chunk that's given away, in your first 2 rounds of fundraising are anywhere from 10 to 20%, right? So in total, 20 to 40% of your company gone in theory. That means that if I raise $100,000 and I give away 10%, pre-money valuation would be $1 million. Post-money would be 1.1 because I'm saying that before the investment, I'm worth $1 million. I'm adding $100,000 of value. So pre-valuation versus the investment, or add them, you get a post money of 1.1. So in this case, the thing is, let's say your business needs $2 million, right? Now, if you do $2 million and you're only giving away 10%, what does that say? That is a very different valuation number, right? So what that means is as you move up in your valuation need and your capital need, the amount that you're willing to give away, it doesn't provide, but it implies your valuation. So I had a client who needed 100 grand, right? They were pre-revenue. They were trying to figure out what to do. And I advised them, keep your minimum here. You've got so much momentum. You've got all these leads. You've got all this stuff. Like, let's go out there. They raised $100,000 from 5 different people. 5 different people put in 20K checks. They gave away 10% of the company, secured $1 million valuation. And now they use that 100K to demonstrate value. And now they're looking at raising a $3 million seed round, right? They went from the 100 to the 3 million. And the reason that they were able to do that is because they realized that first valuation, it kind of doesn't matter in the sense that as long as you don't get it wrong, meaning don't take $10,000 for 50% of the business, right? That's not a good deal. But losing less than 20% of your business and getting enough money, 50K to 500K to get started, that's all a win in my book, because there's no winning on early stage valuation, because it's not like you're getting paid for early stage valuation. You're getting paid for the exit. And if you strike the right deal in the beginning that gets you one step closer to the exit, and it's not a bad deal, it doesn't have to be a good deal, just shouldn't be a bad deal, then you're going to find yourself in a good spot. Hopefully that makes sense.
No, it is perfect. And like I said, because you literally hit the nail on the head. The friend of mine literally, I think, it was under 50K and gave away so much. And it was just like, if you would have called me or just called something, you know what I mean? And I know
exactly. And and here's the thing, you can always go back and renegotiate, because here's the thing that happens. And I'll give you a little story. That's a sad story, but it's a good story, good outcome. There was a company that was doing well, went to an investor. The investor was hostile, which is what I call investors that do bad deals, because you're smart enough to know that you're screwing somebody over. So let's not play games here. So they went to a hostile investor. The hostile investor gave them $100,000 for 50% of their company, right? That was so devastating that despite the fact that they did well, when they got to their next round couldn't be done because the people that wanted to put money in were like, wait a minute, if we put in money, take the amount that's fair, like the fair deal that's at their level of like an angel group. The CEO will own so little of the company that we will have successfully de-incentivized our engine. It'd be like pulling all the oil out of your truck. It's like, it's just over. It doesn't matter. You know what I mean? It's just not going to function, right? It's just gear on gear. So to that end, CEOs and executive teams need to own a good amount of the equity so that investors go, hey, you want to get rich, right? Okay, well, you own the equity to get rich, right? So keep doing that. So this deal actually had to go back to the first investor and say, hey, Mr. Hostile, just so you know, this company is going to collapse unless you figure it out, and you're going to give us back some of the shares. You're going to take a fair percentage at a fair valuation, and then the second angel group's going to come in. Right. So that is a good story because the company ended up doing okay. There were tens of hours of painful, annoying conversations, especially with two investors fighting with each other to get that across the line. And of course, that's not where you want to be.
No, I completely agree. Thank you.
Of course. Happy to help.
Hey, Aaron, one last question.
Sure.
When you are approaching investors and you're hunting down who's going to be part of that round, do you recommend using any type of CRM system, or do you just build out an Excel sheet with who you've spoke to and why? In
the very beginning, keep it simple. Excel is an easy way to do Google Sheets so you can keep track and you don't lose things. But it's less important that you're reaching out to thousands of people because let's put it like I was talking to somebody and they were like, man, I'm so bad at raising capital. This was like a third-time founder. He's like, yeah, I had to have 150 conversations. Okay. So this guy, I know he's a third-time founder and he's pretty smart. And for him, he was just doing something interesting. So it took a while. I'm like, if it took that guy 150 conversations, it's pretty fair to assume that it's less than that. So that's kind of my rough frame of reference where I assume I'm going to have a pretty penny, of conversations, but I don't assume I'm going to have conversations for 18 months. I just have to be strategic with those 10, 20, 30 that I actually do have to have. And you don't need a CRM to do that. You can just use Excel. Just a question of, the quality of your network, your strategic direction, stuff like that.
Thanks for that. I'm a big tools guy. So I guess follow up to that is, do you use Crunchbase? Do you use AngelList? Any other tools that you utilize when approaching fundraising?
So I use Crunchbase. I think it's a good tool to kind of just keep our thumb on the industry. I use AngelList, but really I use LinkedIn a lot because I'm looking to make relationships with people because I know money may come from funds, but it's sourced by people. So people and building connections and connectivity will serve you far greater than just pursuing, a vague fund. So that's my advice.
Awesome. Thank you so much.
Perfect. Well, thank you, everybody. I appreciate everybody attending, and I'm happy to answer more questions. Feel free to reach out. I actually have to run to a